All right, how's everybody doing? Welcome to an institutional staker's guide to Ethereum. We have quite a panel today, but before we introduce the speakers, let's go ahead and give you a quick rundown of Crowdcast in case you've never been here before. On the right-hand side, we have our chat tab, and you can go ahead and click on the chat tab, say hello, let us know where you're from, where you're calling in from. Below the chat tab, we have a Q&A tab. At any point during the webinar, if you guys have any questions, because we're going to be trying not to go too into the weeds, but if at any point you want us to go deeper somewhere, just ask, say so. We're happy to cater to you guys. And then below that, we have polls. So you can go ahead and click on that. We have a question in there just to better help get to know the group. And then below that, you can see the people. Awesome. From Brazil. Awesome. That's great to hear. All right. So if we just want to go around, my name's Chris. I work at Figment on the marketing team. I'll be your moderator today. Danish, if you want to go next, let the people know who you work for, what you do, and all that jazz.
Yeah, absolutely. Hey, everyone. My name is Danish, and I currently lead the crypto business at a Canadian financial technology company called Wealthsimple. We offer a set of financial services products for retail clients, and crypto is one of our business units. And I oversee the entire Canadian operation for the crypto business at Wealthsimple.
Awesome.
Jumped right in there. Hi, everyone. My name is Brian Mosoff. I'm the CEO of Ether Capital. We're a listed entity in Canada in the capital markets. We hold over 45,000 ETH in our treasury and staking 75% of that. I've also been in the industry for about 10 years. So I wear two hats. I see what's happening on the crypto native side, and then also what's required to exist as a public company and what is appropriate to take those assets and make them productive and the challenges that come along with it. And we are partnered with Figment, who is running validators for us. So exciting to chat about all this stuff here today with everyone who's joined.
And Benjamin.
Thanks, Chris. My name is Ben. I'm a protocol analyst at Figment. I focus on the Ethereum ecosystem. So very much interested in the Ethereum base layer, but also everything built on top. So whether it's L2s or centralized exchanges, MEV, DVT, all those things you may have heard about. All those things interest me very much.
Awesome. So now that we know the panelists that will be speaking, let's kind of lay the groundwork for what we're talking about today, and that's Ethereum. So Benjamin, would you like to go ahead and kind of lay the land for everybody here?
Yeah, for sure. And Chris, can you pull up the slide deck?
Yeah.
Thank you. So you can see the items I'm going to go through. They're a bit of a brief agenda, as Chris said, kind of laying the groundwork for Ethereum. But basically what I'm going to be doing is talking about where we've been with Ethereum, where we are today, and where we're going. The TLDR kind of theme of this kind of brief introduction is really that, I think with the latest two upgrades, Shapella in particular, there's a big shift happening with Ethereum. There's a lot of excitement about staking. I think that Shapella in particular is a giant leap forward for the mainstreaming of Ethereum. We've already seen, much more interest in Ethereum, but I think Shapella is the big step, and that's kind of, the kind of theme of the points I'm gonna walk through. And before I get to the first slide, though, I think maybe I take a step back and kind of frame Ethereum a little bit more and why Ethereum has become so important to the ecosystem, why it's so prominent, and why it's such a big deal, and will be going forward. So you think back and to the start of Ethereum. Ethereum's one of the longest running networks. It has a significant kind of Lindy effect. So here, the idea, if you've heard this before, the Lindy effect, the broad concept is the longer something's been around, the longer it is likely to persist. I kind of relate this to first mover advantage. Ethereum is second only to Bitcoin in that sense, but the kind of killer innovation that Ethereum brings to the table is the programmability piece. So you take a blockchain like Bitcoin, you add the programmability or smart contract platform. That's really what makes Ethereum unique. So, you think about what it would have been like to create, for instance, a decentralized exchange before Ethereum, And developers would have to worry about the decentralized exchange itself, so designing that, all the logic, the UI, all of that stuff. But they would also have to build an entire other network, so something that looks a lot like Bitcoin, for instance. The genius of Ethereum is allowing innovators and builders to create these things, but Ethereum takes care of the networking layer and the consensus layer, and developers can just focus on the application layer. So when you consider that innovation, along with the fact that the kind of ethos of Web3 is open source, you take a great idea like allowing folks to add programmability to the blockchain, and you open it up to all sorts of innovators and builders. You really get something special, and that's what Ethereum is. It's the longest running network that adds that capability. So let's get into some of the upgrades that we've seen on Ethereum and where Ethereum's been to get to where we are today. Next slide, please. So, obviously, I imagine we have lots of different knowledge levels on this call. So for some folks, this is going to be kind of obvious stuff. For newer folks, this might come as new information. But the merge, if you've heard of that, happened September of last year. The whole reason for the merge was about sustainability. So the idea is, before the merge, there were miners and Ethereum was proof of work. And that required a tremendous amount of energy. And you can see that in this chart, the top chart, the bar chart there. It's a little bit hard to make out, but in the middle, there's a purple bar. It says ETH POW, that's proof of work. And the idea was that running Ethereum is very energy intensive. So the core community decided that we needed to move away from that and move to proof of stake, which is much less energy intensive, much more sustainable. And you can see the furthest column on the right, there's actually no column because it's so small, but Ethereum and moving to proof of stake goes from 78 terawatt hours per year to 0.0026. So there's a gain. In other words, proof of stake is 99.95% more energy efficient than proof of work was. So that's kind of the headline reason for why the merge. But it's also important to bear in mind that the merge is something that was on the horizon for quite a while. So the beacon chain, what's become the consensus layer of Ethereum, was launched back at the end of 2020. And as the core team was designing the beacon chain, knowing that validators and proof of stake would take over for proof of work, there are lots of design decisions that went into building beacon chain. And so what you get is these other changes to Ethereum that coincide with the merge. So they're not the reason for the merge, but they're kind of what I call happy benefits. One of the big ones is issuance. The bottom chart you can see is the ETH supply since the merge. So the leftmost vertical line, that represents the merge. And the blue line you can see is the supply of Ether since the merge. And you can see for the first 4 to 5 months, it was relatively consistent. And then it started to drop off. And one of the big reasons for this was that issuance following the merge, so the consensus rewards paid to validators to essentially run Ethereum, compared to what was required for miners, dropped by 90%. So the amount of issuance following the merge decreased by 90%. There's another piece here that has to do with the burn. Now that's related to network usage. Essentially, there are 2 layers of fees. There's a base fee, which forms the majority of the expenses a user pays when they use Ethereum, when they engage and transact on Ethereum. Roughly 95% of those fees are burnt. And so when you stack those 2 things together, you see a profile for supply that is either relatively stable, meaning it's not growing, or it's in fact decreasing in supply. And you can see that in the last few months, the supply of Ethereum has gone down. So I would call that one of the happy benefits of the merge. It was something that was built into the beacon chain. And with the merge, you can see those changes coming to the fore. So from a network perspective, again, the cost to secure the network has decreased by 90%. And in fact, the cost to attack the network has gone up by a factor of something like 3 at the time of the merge. So when you look at it in terms of Ether spent to secure the network, you get an increase of 30 to 35x what we had pre-merge. So there are all these things that happen with the merge. Again, the reason for the merge about sustainability, but you have some of these happy benefits. For instance, the issuance of Ether has greatly reduced following the merge. And you have a whole bunch of other benefits as well with the merge. Next slide, please. So zeroing in a little bit more and thinking about the experience for validators coming through the merge. As I mentioned, the beacon chain, what became the consensus layer, was launched at the end of 2020. And so what you had for a period of time between the launch of beacon chain and the merge, September of last year, you had two chains running in parallel. Okay, you had mainnet, which was proof of work, and you had beacon chain, which was proof of stake. Now, for anyone using Ethereum, they were still using mainnet. Before the merge, they were still using mainnet proof of work with miners. Following the merge, though, validators kind of took the reins in terms of building blocks that include transactions and coming to consensus about the state of Ethereum. Before that, on Beacon Chain, they were coming to consensus about the state of Beacon Chain, but for everyday users, that wasn't overly interesting. There are no real kind of quote unquote real transactions happening on Beacon Chain. But so when you look at the chart here that I have, you have consensus rewards, the dark green band at the bottom. Those have been paid out on Beacon Chain since the launch. But the darker green, the more volatile series there that you see come in, those are execution rewards. And those come in after the merge. So these are two reward streams that are received by validators. And consensus rewards you can think of as being paid by the network to validators, to have validators essentially run Ethereum. Think of Ethereum as a global computer. Validators are the ones that are running that network. And those, so that the new issuance of Ether, that is consensus rewards, are paid by the network to validators to run Ethereum. The darker green is paid by users of Ethereum to help expedite their transactions. So I mentioned the base fee before, which is burnt. That's kind of the default fee. It's determined by the network and demand for block space. But there's this added thing called a tip or priority fee that users can pay to expedite their transactions. Those are payments from a user to the proposer of the block, that is the validator. And that's that volatile series you see in dark green. The takeaway here is that execution layer rewards are more volatile. More importantly, though, they're related to use of the network. So they're related to demand for block space. The one thing I want to kind of point out here that I think sometimes can be missed with the merge is that there was a bit of a paradigm shift. It's not just about sustainability and validators taking over for miners. But when you think about the primary input to running Ethereum, the shift is from computational resources, specialized hardware of miners, and energy. Those are the primary inputs before the merge. After the merge, the primary input is Ether. Now, you still need computational resources, but you need much less, and the cost is much lower than it would have been in the past. The primary input for staking is Ether. That's the largest cost item by a pretty healthy margin. So when you take that into consideration, and you take into consideration the fact that validators are now receiving these execution layer rewards that are related to usage of Ethereum, I think what you get is a much tighter connection between the folks running Ethereum and the incentive to see its widespread adoption. Because again, to run Ethereum, the primary input is holding Ether, essentially. You're staking Ether, but implicitly you're holding it. And the other part is you get these execution layer rewards that are related to Ethereum usage. So I think that's one of the key things to keep in mind. There's a much tighter association between the folks running Ethereum and the desire to see its widespread adoption. Next slide, please. Now, as important and necessary as the merge was, I would argue in terms of staking behavior, the recent upgrade Shapella was much more important in terms of getting folks staking. For a reminder for folks, this happened April 12th, so almost 2 months ago now. And Shapella were a handful of upgrades on both the execution and consensus layers. The headline theme, though, of course, are withdrawals. Shapella made withdrawals possible. There are two flavors of withdrawals. There are partial withdrawals. So any amount above 32 ETH is automatically swept from the validator to their withdrawal address. And then there are also full withdrawals. So these are for folks that want to exit. They don't want to validate anymore and they want their stake back. So there are those two flavors. The one thing I would also emphasize on the partial withdrawal side is that they're automatic. So validators can't request a partial withdrawal, nor can they prevent it from happening. It just automatically happens. So when you look at the chart here, I have the green bars above the horizontal line are deposits. And you can see where the first yellow bar on the bottom, that's where Shapella happens. And you can start to see more and more activity there on the chart. The yellow bars represent rewards or partial withdrawals, and the blue bars represent full withdrawals. That is validators requesting their stake back. I'm not going to run too much into the dynamics of the chart, but big picture, what we saw around Shapella was an initial, a lot of demand on the exit side and a slower, more consistent build on the activation side. So taking a step back for folks that are maybe a little bit newer, there are only so many validators that can enter or exit the active validator set at any one time. There's a limit per epoch, and epoch is about 3.4 minutes. And so when you get more requests to activate than that limit, you start to see a queue. And you see the same thing on the exit side. So what we saw initially with Shapella was a spike in exits. And I think we reached a maximum of 16 to 17,000 in terms of the exit queue. And what happened is over the following weeks, that queue got smaller and smaller and smaller as Ethereum processed all of those exits. And this is well known for folks following. We knew about Kraken, we knew about some of the regulatory actions happening, folks being forced kind of out of the space, out of the staking space, and that's exactly what we saw. In my opinion, more interesting though is what we've seen on the activation side. So the initial action on the activation side was smaller in magnitude, but it's been consistently building. As I mentioned, it's been almost 2 months since Shapella, and I've been watching the activation queue on Beacon Chain. That's an explorer for the consensus layer. And there have been some pauses, but generally speaking, it's been up and to the right pretty consistently for 2 months now. We're now at the stage where we have roughly 95,000 validators waiting to be activated on the Beacon Chain, or on the consensus layer, I should say. It's going to take about to the 3rd week of July to process all of those activations. And to me, what's so interesting about it is that it hasn't stopped yet. We've seen brief periods where it kind of pauses, and maybe Ethereum works through a few of the deposits, so it goes down just a little bit, but then it continues up. So it hasn't stopped yet. Next slide, please. And just to kind of help put this into perspective, into historical context, we've never seen this before. This chart shows weekly staked. It's from Dune Analytics. It gives a breakdown in terms of who's doing the staking, liquid staking, centralized exchanges, staking pools, etc. That's interesting. That's not really my focus of the slide. It's more the magnitude of the move. You can see roughly where Shapella's happened and the consistent increase in staking. Folks may remember early last year, there was also an activation queue. It was a lot shorter. It wasn't 6 or 7 weeks. It was more like 2 to 3 weeks. So nothing like what we're seeing today. The other point to add, the maximum number of validators that could be activated at that point was between 4 and 5 during that time. Now we're talking about 9. So my point here is that Shapella has removed the last really important hurdle for folks to stake, and we can see it. We're seeing it in the numbers. The kind of piece that I'm adding on is that because of that tight relationship between the folks running the network being incentivized to see widespread adoption, I think the pickup we're seeing in staking represents a big step forward for mainstreaming Ethereum, not just from staking behavior, but the ecosystem adoption as a whole. And also, I just encourage folks, before I go on to the last slide here, I would really encourage folks to watch along. And regardless, if you're just getting to Ethereum or you've been watching it for a while, I would really watch the queue, because as I say, I haven't seen a meaningful let up in the activation queue yet. And I think that's a really important indicator to watch. So you can go to Beacon Chain and you can watch. I watch on a daily basis. I just check in every so often to see what's happening just for interest's sake. But I really do think this represents, Shapella in particular, represents a meaningful turning point for Ethereum. And that's one place you can see it. Next slide, please. So that's kind of where we've been, with Shapella, what we're seeing in terms of interest in staking. There are a few things coming up for the ecosystem that are also very interesting. I would say that Shapella, I think, as I said, is more important for the ecosystem than I think folks realize. It's not just about staking and withdrawals, but has larger implications. But one of the interesting or the two upgrades coming up, Cancun and Deneb, are more specifically about users and about scaling. So like Shapella, there's a headline feature called proto-dank sharding for Cancun and Deneb. These are the next. Cancun is the execution layer upgrade coming. Deneb is the consensus layer upgrade. The important thing to understand, though, is that the headline feature of these upgrades is all about scaling. So if you've heard about proto-dank sharding, EIP 4844, the big picture idea is that roll-ups have been very successful at scaling Ethereum. And for folks that aren't as aware of roll-ups, you can think of roll-ups as being little mini networks built on top of Ethereum. The way I think about them, the easiest way is like a little mini Ethereum built on top of Ethereum, whose goal is to scale Ethereum. That is to make transactions cheaper and to increase throughput. So the idea is that things are built on top of these roll-ups, these little mini Ethereums built on Ethereum, and folks can send their tokens to these roll-ups and then engage in all kinds of apps that are built on the base layer as well. And the transaction costs are typically 10 to 100 times less than the base layer. So there are significant savings. The idea with proto-dank sharding is just to take advantage of that further. So the Ethereum core community said, what if we could just carve out a little bit of block space specifically designed for rollups? There are specific needs that rollups have for block space, and this block space can be made cheaper than the typical block space because the needs of rollups are different than everyday users. So big picture, that's proto-dank sharding. The other thing to note there is that proto-dank sharding is a stepping stone on the way to full dank sharding. Full dank sharding is something that's coming down the road. I'd say, you know, a year or more down the road. There's some things that have to happen before we get there. But that's really the big step forward for rollups. This is kind of setting up the infrastructure for rollups a little bit better. And but there will be some decreases and some notable scaling impacts of proto-dank sharding. The other two things that are coming up are more geared towards stakers. So distributed validator tech. Here, the idea is that you can replace a validator with a cluster of validators. So there are multiple validators within a cluster. And effectively, what you're doing here is you're eliminating the single point of failure. That's the kind of big picture of DVT. I can go into the weeds a little bit more if anyone has questions on it. But the analogy I use here is think of a multi-engine airplane. If that multi-engine airplane loses one of its engines, it can continue flying. That's the idea with DVT. You replace one validator cluster, or sorry, one validator stack with a cluster of validators. So you can lose, you know, some number of validators up to a third of that cluster, and the cluster can still perform its validation duties. Last one to mention before I finish this initial piece here is eigenlayer. So the idea with eigenlayer is that you can use your staked ether to stake on other apps and other networks built on top of eigenlayer. So if you think about it today, if you want to engage in multiple networks or multiple applications, you usually have to go and buy the token and then stake it for a proof of stake network. So what this means is you'd have multiple tokens, you'd have multiple networks. But what's interesting about eigenlayer is that you can use your staked ETH to engage on those other opportunities. In other words, it's called restaking, but the idea is your staked ETH is a little more efficient. The very fact that you're staking on Ethereum and running a validator on Ethereum means that you can participate in other things that are built on eigenlayer. So from a staker's perspective, you can think about it as the potential to opt into other opportunities to earn additional rewards. That's kind of the big picture with eigenlayer. So closing out the section here, to me, the big picture is when you think about Shapella, the ability to withdraw your stake and consensus layer rewards, that's obviously very important. Folks have been waiting since the launch of Beacon Chain at the end of 2020 to have that capability. It's extremely important for staking, but what I would argue is that it's actually really, really vital for the entire ecosystem. And I think that this is going to lead to a massive step forward in terms of mainstreaming Ethereum. And I think, again, you can see it on Beacon Chain. You can see the excitement and the demand for staking. But what I would say is that one step forward, that actually leads to widespread adoption. So that's what I've got in the way of prepared remarks. Happy to answer questions on that if there are any, but I'll take a pause.
Thank you, Benjamin. That was awesome. Go ahead and there we are. There's my face. All right. So just bringing this all home, we've kind of learned what Ethereum is, some of the things that we've seen with the merge, and now that Shapella is live. But zooming out, like, why are institutions should care about staking? Like, why stake on Ethereum? Brian, I remember one of our conversations we had, you put this real well, but if you could get 5% elsewhere, why even mess with Ethereum?
Yeah, and if I can add some color to the presentation from Ben, I think if we zoom out and look at kind of the history of the space, at how are you supposed to participate? One thing that's really great about staking, specifically for me, is, I mean, we talked about the electricity and computing hardware, but the fantasy of all of these assets and blockchains is to have the most amount of participation globally, right? It's not meant to be a company. We're trying to build the most access possible. And a problem in proof of work mining was that you ended up with this concentration in parts of the world, or with people who had access to electricity and computing hardware. And we saw that happen. Someone at home like me paying 12.5 cents a kilowatt hour, there's no way I'm going to run a Bitcoin miner at home. And Ethereum, when it transitioned from proof of work to proof of stake, said, listen, you don't need the electricity and computing hardware. You can just use your ETH as the thing that you're putting up into a bond with the protocol. And so more people can participate. And so that's a great thing. And, you know, when I think about what is staking, it's helping secure the network. It's helping secure and process transactions. And so the history so far of staking has been people at home. Mostly it's tech enthusiasts. And now the question is, the institutions who have been sitting on the sidelines, you know, why should they care about Ethereum? Should they even care about Ethereum, or should they care about another blockchain? And if they are going to build a position in Ether, should they be making it productive, or should they just be, you know, hold and take a long view and go away? And so I think where we're at now is this transition from, people globally have accepted blockchains are here to stay. Certainly Bitcoin and ETH are the number 1 and number 2 by market caps. They're the ones that are likely to be around in the next 5 or 10 years. I'd be shocked if they weren't. And so one nice part about the bear market is, I think that we're getting rid of all the noise of there's going to be all these other layer ones, and there's going to be this application and this new vertical, and it's hard to figure out how to allocate capital. And it's becoming more clear. Bitcoin has cornered this non-sovereign money narrative. Ethereum has really become the dominant platform for all sorts of exciting activity, whether you buy into NFTs or the metaverse or DeFi or not. The point is, that's where the activity is happening. And you can see it in the daily transaction fees on this network. And so for those who say, I'm going to go and buy ETH, and then I want to stake it, I'm going to help secure that network, and I'm going to be able to generate maybe a 4% yield on the low end, and maybe it's up to 8%, depending on, as Ben was saying, the execution fees. That's a great thing. And so I think it's becoming clear now that staking has been live for a couple of years, you know, in various flavors, depending on which upgrade and when, but it's here and it's stable. It's not a brand new thing. It's not 2 days old and we're debating if it's still appropriate to stake or not. It's no. This has been tested. There's companies like Figment out there who are doing it, who've been successfully running validators with constant uptime, who are not getting slashed, who are paying out their rewards. And so now you have people like Ether Capital saying, we're sitting on this 45,000 ETH. Let's start staking $50 million. Let's generate a 5% yield on that. Let's help secure this network and return that yield to our shareholders, or to a fund, you know, whatever it is that the structure of your entity looks like. And that's a really exciting time. And you can come into this knowing that there's not only what's happening on Ethereum now, but as Ben was saying, there's all these future opportunities to make staking safer, to generate potentially even higher yield through other things, you know, call it eigenlayer, call it other things, and DVT for safety. But the point is, it's safe and it's an opportunity to generate a yield. And why someone would want to do this is not just for the 5%. I get asked a fair amount at Ether Capital, if I can get 5% through some dividend paying stock or some money market fund that pays up higher, why would I do this? Why would I buy ETH and stake it? And it's the wrong way to think about it, because it's not just about the 5%. The reason that people should want to build a position in ETH and stake it is because they already have a fundamental view of Ethereum as an asset, and they want exposure to that asset, and they believe that there's still a fair amount of upside, whether it goes back to all-time highs or higher or a little bit lower. The point is they're starting with a view that Ethereum is going to be a very fundamentally important technology for what comes in the next cycle, or tokenization of real-world assets and real-world businesses figuring out how they use blockchains, and Visa's going to test this thing out. Ethereum is going to sit at the core of that. And so if you have that belief, you're probably thinking about how you're going to build a position in Ether. And then you say, while I have that long view, a low time preference, 5 years, 10 years, 3 years, whatever it is, I'm going to make the asset productive. And then the conversation will turn to, what is the best way to stake? And there's many different ways to stake, through centralized exchanges, to running your own infrastructure, to partnering with a third-party provider. And there's no right or wrong answers to any of those buckets. It has to be considered, or you have to take into consideration what you're trying to achieve, what your technical expertise is in-house, what you want to outsource. And we can dive into that or not. But that's the message here, is for people who believe in Ethereum, they believe that there's a future in all of this smart contract application activity, then they want to make it productive and help secure the network. That's what's really exciting. Ether Capital has been staking for over a year now with Figment, very successfully, very exciting. We're going to continue to do that. We're going to continue to evaluate opportunities that are coming down the pipe to generate additional yield and again, help secure those networks. And so we want to see more people participate in this. We want to help solve the tooling around how you do the monitoring and the financial reporting, and how does it plug into your back office, and what does it mean in terms of registration to your local regulator. There's all these other little nuances that can make you bang your head against the wall, but they're solvable problems. And certainly for institutions, there are ways to get access and participate here. So happy to answer any questions as well.
Thank you for that, Brian. That's one of my favorite things about the space is how it's not just one way to do anything. It's all about, what's your comfort level, what's your level of knowledge, expertise, and, what are you really willing to, your risk tolerance. And Danish, I really would like to ask you, because, you launched the first regulated staking product for retail investors in the world. And what have you seen since then? What's the state of the union on staking, and from your perspective with that? And maybe we can also rope in AWB's question of what metrics you're looking at to gauge adoption of staking, or particularly for Ethereum.
Yeah, absolutely. So as you mentioned, Wealthsimple in Canada launched the first regulated staking platform. And this was important for a few reasons. So as Brian mentioned, there's a number of different stakeholders in across the globe that participate in the crypto ecosystem today, and others that want to but haven't been able to so far. And a critical segment in that group is retail users. Now, crypto so far has largely been a retail phenomenon, but even within that segment, it's been a very small group of users that have had the capital, the technical sophistication, and the general appetite and interest to participate. But over the last few years, we've seen that only increase. And the role that Wealthsimple is playing is essentially making it much easier to enable this very large segment to access this new capability that would otherwise be inaccessible because they don't have, let's say, enough capital to buy the necessary ETH to run their own validators, or they don't have the technical sophistication to operate their own validators, or they just don't understand the nuances of staking and some of the risks or complications associated with doing so. And so that's where a platform like Wealthsimple really tries to step in and solve those problems on behalf of our clients. And so we try to do that in a few ways. The first is around ensuring that the core product experience is as simple and seamless as possible. So we covered a number of different nuances and technical components of what it takes to stake. Our clients don't know or care about any of that. They want to solve a very particular problem, which is getting yield on their Ethereum, or it's participating in securing the network. And so creating a product experience that abstracts away all of that complexity is a core part of what we've done with the crypto product at Wealthsimple. The second is around providing the education around what this actually is. So many clients we've seen as we've launched these products are very eager to learn. They want to know what staking is. They want to understand risks on specific things like slashing. They want to understand how things work under the hood. And so making all of that information easily digestible through a variety of different content that we provide, both in-app, through articles and blogs that we publish, and through platforms like these, it's a critical part of the role that we play in helping the broader retail market get educated on what's happening in this ecosystem. And then lastly, which I think is probably the most important, is around safety, security, and risk. And so a lot of the investments we've made in becoming a regulated platform is ensuring we have the right operational checks and balances, the right vetting process for the partners that we work with to run a stable and secure staking product. And that is ultimately what we are offering to our clients through this simplified offering. And all of that has translated into a ton of interest in staking, both before and after the Shapella upgrade. I think as of right now, we have about a quarter of clients who have ETH at Wealthsimple actively staking, which is much higher than what I would have anticipated, but it's clearly shown this demand for people to want to participate in this ecosystem. And of those that are staking, I think almost 80% of their ETH is staked. And so people are really committing to this long-term vision of having the exposure to the asset class, but also contributing to its long-term security and stability as well. And so, in terms of what we look at metrics-wise, I think one is definitely this just like general adoption. Like, how are we seeing, especially in a bear market where there may not be as much retail interest, how is that translating into use cases beyond just the speculative nature of just buying and selling or trading? And as I mentioned, a quarter of our clients are already participating, and I think that will only increase as withdrawal times get shorter, as the times to spin up new validators get shorter as well, making it much easier and reducing the friction. And I think general awareness by like these types of forums, as well as other ways for clients to engage in staking, will only increase that. And so it's been awesome to see the early adoption that we have seen so far.
One thing I would add just on the institutional side is I think it's easier for funds to stake their treasuries. The question next will be when we could bring other structured products to market in Canada, the US, whether they're closed funds or ETFs. I know in Europe, there's already some ETPs that offer staking exposure. It'd be great to see Canada. We helped build the first Bitcoin and ETH spot ETFs with Purpose Investments. If we can get the regulators comfortable with building some kind of fantasy would be a staked ETH ETF. It's certainly the cleanest and best for investors, whether they're retail or institutions, to buy as a single access point. That would be great. My suspicion would be that inside of an ETF structure, you wouldn't be able to stake a significant amount of the assets up front. I think it would take time to get the regulators comfortable with that. And it would start with maybe 10% of the holdings being staked, because you have considerations that have to be made around daily liquidity. It's specifically in that type of structured product, but I think that we'll get there. We'll get from 10% to 25% to 50% to maybe 75 or 80%. We'll see. These are conversations that I have a strong personal interest in. But maybe we see something like an offering memorandum or a closed fund. Maybe that comes to market first. So that would be great for institutional adoption. I think it's certainly the easiest for those who just want to buy something as the proxy to the activity, that they have trouble internally saying, well, we're going to do custody of our own ETH, or we can't use the custodians that exist for whatever internal policy. So again, you're going to see all sorts of different types of institutions on different timelines figure out what their access point is going to be, when they're going to start to choose their access point, and what fits into their internal mandates. But Ben's point before, where he talked about that activation queue, whether we think like one thing that I always try and point out to people when they say like, when will real world businesses be using this technology? And in a way, a question of like, when will institutions start adopting this? I just want to make sure that people aren't saying that if institutions adopt it, that's how they'll validate that Ethereum has use case long term. I think that's not the right way to think about this. It's great for institutions to be here, but the network can survive with or without the support of those institutions. So Ben's metric on that activation queue tells you how many people globally, whether they're an institution or an individual or, you know, through a centralized exchange, more people want to participate in the activity. They trust that the activity is safe and sound and ready to engage in. And that's a great metric because it abstracts away. Doesn't matter who it is. The point is more people are buying into, buy ETH, stake it, generate the yield. So watching that activation queue is also a great metric.
Building on that, Brian, are you seeing institutions onboarding via liquid staking protocols or non-liquid or staking as a service providers, and why?
I haven't seen that exactly yet. I think things like Alluvial, you know, would be great to for institutions. And again, it depends on what the structure of the fund or what the institution's trying to achieve. And so maybe it was Danish before, Ben was saying that there's an access point for anyone and everyone. So a liquid staking token, for those who don't know, is essentially a token. You're tokenizing the activity and saying you don't have to run the validators. Other people run the validators, and you buy this token that represents a claim on the activity and the underlying assets of those validators. And we're going to buy this, and that's the proxy to the yield plus the ETH exposure. That may be something that works in closed funds or some type of offering memorandum. I haven't seen that yet, but it's something that's very exciting. I know Alluvial specifically is focused on that. Lido, I'm sure, would like. Lido is another big, for anyone who doesn't know. There are a few different liquid staking tokens that are out there. There's Rocket Pool and Lido, and there's a number of these things that are out there. The question is what fits into some type of prospectus, or again, inside of the guardrails of whatever the institution is able to do. You know, what's their comfort level on what the liquidity looks like, or the transparency around how the token works relative to how the validators are being run, and can they thread the needle in their compliance departments. So there's all sorts of things that have to be thought about. Yeah, so we'll see in the next 12 months. Will be interesting because I think now that withdrawals are enabled, institutions that do believe long-term in this asset class, you're seeing Franklin Templeton doubling down. I was at Consensus, a big conference in Austin about a month ago, and they had a big presence there, and they're looking at this space and they're taking a long view, and they're saying, we're not spooked by the bear market. We want to figure out how we're going to participate. We're going to build a venture fund. We're going to maybe build structured products. And so they'll start evaluating all of these things and figuring out how to make them work inside of their organization.
And I'll just kind of open this up to the group, whoever feels like they have a good answer for it. But what are some of the risks that you assess when you're thinking either I'm going to hold the asset, I'm just going to hold Ethereum, or I'm going to hold it and stake it? What are the different risks there?
I mean, I guess.
Yeah, go for it, Ben.
I mean,
I'll drink my coffee, which I've been enjoying this entire time.
Magnificent coffee. So, I mean, yeah, there are some pretty clear risks in terms of staking, in terms of downtime and slashing and things like that. So I think this is where you really need to, if you're looking at direct staking, for instance, you really need to understand the nuances of Ethereum. You know, how do you maximize, let's say, risk-adjusted rewards? So once you take into consideration all the risks, and what's the best way to do that? So there's a fair bit of nuance to rewards and penalties in terms of staking on Ethereum. So I think that's one of the big things. And if you look at staking service providers like Figment, you need to really get into the weeds with any staking service provider and understand how they view rewards and penalties on Ethereum and how they mitigate those. You know, I don't think I'll get too much into the weeds right now on our approach. I think though that, you know, some of the philosophies that we have recognize kind of the nuances of Ethereum. You know, in a lot of instances, for instance, downtime penalties are preferable, let's say, than risking a slashing event. So for folks that aren't as aware, slashing has a very specific meaning on Ethereum. the TLDR here is that you suffer a significant penalty versus downtime, and when comparing to downtime penalties, and you're ejected from the active set. Now, depending on what's happening with the exit queue, if there is one, this can be especially punitive. And it was much more of a penalty, let's say, before Shapella, when your ETH was just locked up indefinitely. But it's still a very significant event, and you really want to avoid slashing. So, you know, when talking to staking service providers, I think one of the things to ask them is how do you view slashing risk? How do you minimize it? And how do you think about that in terms of downtime? You know, there are some staking service providers that seek to optimize uptime. They always want to be online, but by doing that, you actually incorporate some other risks. So, you know, on the whole, obviously, staking is certainly worth it from my perspective. I think for a lot of folks, but you have to do it right, and you have to seek to the best risk-adjusted reward. And from a customer's perspective, you have to understand what kind of risks you're taking, and what risks are you willing to take, what risks are you not willing to take, and just line up with your staking service provider and make sure that you're on the same page.
Do you want to add anything to that, Brian?
I mean, there's all sorts of risks of, you know, monitoring, and we talked about slashing risk, but considering, you know, if you needed liquidity and the exit queue is long, and for some reason you couldn't unwind your position to sell your ETH, and for whatever reason or product you're building, that's something that needs to be considered. If you, like, again, there's that spectrum, right? That if companies or institutions say, we're going to run this internally, then they get into key management. Who has access to the validator keys? Who has access to the custody key? You know, there's all sorts of things that have to be considered when doing this. It's things that at Ether Capital, like, we run our own self-custody solution through a multi-sig, meaning we have a number of directors and people from management who sign off on the custody of the ETH, but then you get into, well, now there's key management. And I mentioned before that we are staking through Figment, and there's things like, we want to know that if something happens to our third-party validator service company, that we have a copy of the exit transaction. Not a common thing, but something that we've started to chat with the folks at Figment about, that potentially regulators are going to want to see. We're structured as a corporation, which gives us more flexibility than some type of fund. But I think as we move into the world of fund structured products, those will be probably requirements that the regulators will demand. And so figuring out, well, who's going to keep a copy of the encrypted exit transactions, and who has access, and what's the protocol around when you would broadcast that out to the network, you know, there's all sorts of things that have to be thought through. So there's all sorts of different risks. I wouldn't say that any of them, well, they're all detrimental in their own way, you know, if you really get it wrong. So I think the TLDR here is, you have to be thoughtful and work with someone or a group of people or a company who's really in the weeds on this stuff. This isn't really a click a button and hope for the best kind of thing, especially at scale. That may be appropriate for someone at home with a USB key, ledger, Trezor device. That's fine. But as you start getting into 5 million, 10 million, 50 million, $100 million plus, you're going to want to make sure that you have well-documented procedures and controls around what you're going to do. And that's more than, in my view, just, well, we outsource it to a third-party vendor and hope for the best. I think that it needs to be a collaboration on, we're the institutional with the capital. We need to understand the relationship between the custodian and the staking provider, how they interact, what happens in a disaster case scenario. Because we've seen in the last year things happen with what we thought were trusted above board entities, not that they were in the end, but that there were no protocols in place of what to do. You know, if this happens, then we do this. And so I'm hopeful that more professional capital starts thinking this way of, how are we going to monitor these things? What are we going to do if something happens, if a validator goes offline? How do we disclose that to our shareholders, our LPs, whatever it is? That to me is the best experience for an LP, a unit holder of a fund. And it is going to take time to work through these things. There's a very small subset of people who have had to go through these challenges. I guess I'd say, fortunately or unfortunately, I'm one of those people who've had to deal with it. But we're going to see more come online in the next 12 months. You're going to see globally more people participate in the activity and work through what best practices are. And this is like, it's like we're at the, I think about the nexus to this would be custody wasn't a solved thing really for institutions in that 2016 to 2018 era. You had the Geminis around and you had the Coinbases, but you didn't necessarily have the big audit firms who had the internal IP and resources to say, okay, we can do SOC reports for you and do SOC 1 and SOC 2s. So you had the institution saying, yeah, maybe we want to buy into this asset class in that 2017 bull market where Bitcoin's going from 3,500 up to 20K and ETH is on its way to 1,200 or 1,300. And they're saying, well, who's the custodian we can work with? It's like, well, they don't really meet the requirements of what we need yet. But as we moved from that 2018 to 2020 era, you started seeing everyone getting SOC reports. Best practices are emerging for what a proper exchange and custody experience looks like. Liquidity providers coming online that have BIT licenses and are registered as trust companies. And so we're at the beginning of that part of the curve where you're going to see more entities like Figment figure this out and say, we have our own SOC reports and we have well-documented procedures and we have the audit firms working with us, and they're going to become the appropriate access points for the institutional capital to say, we are now comfortable working with entities like you and facing you because you meet our back office and compliance requirements. So that's kind of where we're at, I think, on the journey. So it's still the early days for institutional capital, but it's starting because the mind share is beginning to exist not only in the Figments and the validation service type firms, but also you're seeing the research analysts inside of the investment banks put out research reports that are very thoughtful. I'm reading stuff, again, research reports coming out from analysts from all these institutions going, wow, they know what's going on. They know sometimes more than me and what's coming down the pipe. And that's amazing to see that mind share has now moved internal into these institutions. And maybe they're not the ones yet making the decisions on when participation would happen, but they're putting out the knowledge. They know that these things exist. They're tracking the space, and that will slowly start to leak its way up the chain into recommendations of, we should be doing this. We should be figuring out how would we test this, and maybe they just do it with $100,000. If you're a BlackRock, you should be testing out with $100,000. Let's run 2 to 3 validators and figure out what is our workflow going to look like. Because if they can start to do it internally, they start to learn, oh, we don't have mind share around this. We don't have documentation around that. Who do we partner for this? Should we outsource this or should we internalize this? What does an auditor, do when they look at these kind of things? Because they'll point out some of the risks. So that's where we're at. That's what's beginning to happen, and it's a really exciting time.
That kind of leads us right into what are we seeing coming into the future of staking? We've talked a little bit there about the problem solving that's happened in the course of the last few years. But Danish, I'd be really interested to know, since the launch of your staking product, what were some of the challenges that you had before and after the upgrade? And then what are you seeing going forward for staking?
Yeah, absolutely. I think before the upgrade, I think the challenge was really getting the product up and running in a regulatorily compliant way. And so, we were pioneering a lot of things for the first time in getting this product to market. And so the end product experience is quite straightforward in the sense that it offers retail users the ability to stake Ethereum, but being able to do it through the way we've set it up operationally and have it be regulatory compliant was the biggest sort of first stage to cross. But I think that's set up a awesome platform for us, and I think for platforms in the future, to be able to offer this base level access, which is what most people at this point care about and are interested in. But I think that is going to be the foundation on which so much more is going to be possible. And we touched on this a little bit in Ben's presentation, but with things like EigenLayer and a new ecosystem emerging around staking as a utility and the ways that it can create and contribute net new value for the growing ecosystem of Web3 applications and use cases, like there will be more and more reasons for people to want to participate in staking. And this foundation is ultimately going to be necessary for any of that to be possible. And so we're almost redefining like what staking actually is. It's no longer just providing security and consensus for just like the base transactions happening on Ethereum, but there's an entire new design space being formed around other ways that Ethereum stake can be used to offer new products and services that contribute to the growth of the web of applications and use cases that will be developed on top of Ethereum. And that, I think, is like changing the entire mental model around the role that staking plays from what we've learned it to be today to what it'll transform to be in the next 5 to 10 years, probably. And so I think that evolution is going to be really exciting to help actually bring to market, but also thinking about what that means in terms of the types of individuals, institutions, and stakeholders that want to participate in staking, the things that they might care about, and how do you package all of that into an offering that is still simple and easy to understand, but provides the flexibility and customization or personalization that people might care about when there's a variety of different flavors of what staking for Ethereum could look like. So I think that's like one general direction that is really interesting. I think the other is around the various types of staking solutions that might emerge. So we've already seen examples of liquid staking applications. We're seeing examples of these like single platforms that are offering a combination of custody and staking as one. And I imagine there will be more and more versions of ways that different stakeholders can participate in the staking ecosystem that are customized for a given regulatory framework in certain jurisdictions, given like certain reporting obligations or needs that some institutions may have that maybe retail users don't necessarily care about as much. And I think all of that will transition into having like a variety of different staking solutions that are really bespoke for specific audiences. And I think this like one size fits all approach that we've sort of started with will unbundle into these varying different services that optimize on certain things that people care most about, which ultimately I think serves this end goal of giving as many different types of people the ability to stake and participate in the Ethereum ecosystem as possible, which is ultimately the goal of everything we're trying to do here. And so I think the combination of that plus this evolution of what staking actually represents changing is, I think, are both really exciting times to be thinking about the space and starting to participate in it both directly and indirectly through institutional offerings or other platforms that specialize in this.
One thing I would add was a real challenge for us was figuring out how to match IFRS or GAAP accounting standards. Watching these rewards that are denominated in ETH, at running these 24-hour a day, just rewards coming in whenever, and here's the link to a Beacon Chain Explorer that tells you how much your validator earned. Hand that to a Big Four audit firm and say, help us do our quarterly report. They're like, this isn't in anything digestible to us. And so we ended up actually having to build a tool that would translate those rewards into some type of accounting standard that's acceptable for our quarterly and yearly financials. That was a big lift. It seems like a small thing, but that was a big lift. So that the monitoring and financial reporting side of it was one hurdle that we had to really cross. And I think to bring a structured product that has daily liquidity, closed fund, ETF, that will also have to be solved, or they'll have to use some tool like what we had to build.
Benjamin, where do you see staking going?
Well, I think Danish and Brian have touched on kind of the salient points. I think what we're seeing though is staking will look more and more diversified. Whether that's the individual entity getting involved or how exactly they're going about that. With the merge, we saw the potential to sell block space to builders through MEV Boost. As I mentioned, DVT is coming, Eigenlayer is coming. So, and that's in addition to the various clients that you can run and the various pieces that you can already add to the stack. So I think things are going to become more diversified. And if I could maybe start answering a bit of a different question, I think one of the things I've been thinking about is the core community often talks about onboarding 1 billion users, and I think that's helpful for folks following along and watching what's happening and what the roadmap looks like. and what the areas of focus are. I think that is a helpful framework. But I think oftentimes people just take that and just dismiss it and they're like, oh yeah, whatever, a billion users, whatever. But I think people need to take that seriously. Ethereum will onboard 1 billion users. I really believe that. And I think that you're seeing that more and more if you've been following along. Ethereum has set these ambitious goals. When I say Ethereum, I'm talking mostly the core community, but everyone involved. That includes folks running infrastructure, that includes folks staking, holding Ether, all of that. And they continue to meet these targets. So I think that's coming. And I'd really, really encourage folks, I like the idea of dipping your toe in, but if you can't even get there, then I'd really, really encourage folks, just follow along. I mentioned Beacon Chain. I'm going to drop the link in a second if folks aren't as aware. Wrong thing. There we go. And also, like, every week, every Thursday, there is a public call. So whether it's the consensus layer call or the all core devs call, every Thursday there's a public call. You can hear what the community, the core devs are thinking about, the Ethereum Foundation is thinking about. They do all of this in a very public way. So if you can't quite get there, if you can't quite get to dipping your toe in terms of Ethereum, if nothing else, just follow along and watch what's happening. Because I really think this is an incredible turning point, and we're watching it happen, in real time. I mentioned Beacon Chain. You can watch the queue, but there's so many other ways you can track Ethereum. So yeah, really, really encourage folks to do that.
Awesome. And we are at time. Danish, if you want to let everybody know where they could find you, how to get a hold of you, and we'll just kind of go around.
Yeah, sure. I think Twitter is probably best. Twitter.com/Ajmeri. I'll throw it in the chat as well.
I can be found either by email, brian@ethcap.co, or on Twitter at Brian Mosoff, just the way my name says on the screen. I don't need to spell it, so just type it and send me a DM, I suppose, if you have questions. I'm also on LinkedIn. All the usual places that you expect to find people in 2023.
For me, email is pretty good. Benjamin@figment.io. You can follow me on Twitter, builder_Benny. I'm not the most prolific on Twitter, so take that for what it is.
And I am Calico Kitten Cat everywhere. So there you go.
That
Thank you
you're going
guys.
to need to spell for us.
Awesome. Well, thank you guys so much for showing up. If you guys want to see a recording, you can view the recording with the link that you joined. Until next time, happy staking.
Bye, everyone.
Bye.